You've probably noticed something strange over the last few years. People are working harder. Prices are rising. Your paycheck might be bigger than before, but you feel worse off. Your rent takes more of your income. Groceries cost more. Healthcare costs have skyrocketed. You save less than before. And you ask, why does it feel like the middle class is disappearing? Today, we're going to explore exactly that. Using 2025 data and news, economic research, and clear logic. With simple explanations you can follow even if you've never taken an economics class. The term middle class sounds familiar, but what does it actually mean? Economists usually define it by income relative to the national median household income. According to the U.S. Census Bureau's latest data, the median household income in the United States was about $83,730 in 2024, meaning roughly half of U.S. households earn more and half earn less. By convention, households earning between two-thirds and twice the median are often considered middle class. That puts middle class roughly between $55,000 and $168,000 per year, a very broad range. But income alone doesn't capture what life feels like because actual cost of living matters. In many parts of the U.S., earning $80,000 doesn't feel enough, and that's exactly the gap we'll explore. Researchers have been tracking the share of the population that falls into middle income. In the 1970s, about 61% of U.S. adults lived in middle-income households. By the early 2020s, that share had dropped to roughly 50%. This long-term trend shows fewer Americans fall in the middle band than before. What's more telling is not just count of incomes. It's the share of total national income going to middle earners. In the 1970s, middle-income households took home over 60% of national income. In recent years, that share has shrunk to around 43%, 45%. If wages are up, then why do people feel financially squeezed? One reason is what economists call real wages, wages after adjusting for inflation. In 2025, typical wage growth has been modest. Data from the U.S. Bureau of Labor Statistics and Federal Reserve Analysis shows average hourly earnings increased in the low single digits, generally 3–4% annually over the past couple of years. At the same time, inflation has driven up the cost of rent and housing, food and groceries, insurance and healthcare, transportation expenses. Even though headline inflation eased from its peak levels of 2021–2022, many of these essential costs remain significantly higher than their pre-pandemic norms. For example, grocery prices remained elevated compared to pre-COVID levels, even through 2025 Wall Street Journal analysis. Healthcare premiums have continued to rise faster than wages. So while nominal income rose, the value of that income, how far it goes, did not. This dynamic is fundamental to the perception that income doesn't feel higher even when the numbers do. One of the most critical pressures on middle-class budgets is housing. According to the Harvard Joint Center for Housing Studies' 2025 report, housing costs are historically stretched. Median home prices remain significantly above historical averages. Rents in many markets are near record highs. A growing share of renters and owners are cost-burdened, meaning they spend 30% or more of income on housing. At the same time, mortgage interest rates, after rising sharply in 2022–2023, have stayed elevated through 2024 and 2025. Higher rates mean higher monthly mortgage payments, higher qualification thresholds for potential buyers. For a typical middle-income earner, this spells two things. Buying a home is less affordable. Renting consumes more take-home pay. A key structural shift over the past few decades has been asset income has grown much faster than wage income. What does that mean? Returns from assets like stocks, real estate, business ownership grew significantly from 2010–2025. But wage income, the paychecks middle-class families earn, grew much slower. This divergence creates inequality in two steps. Wealthy families benefit from asset growth. Middle-income families rely mostly on wages. A 2025 Brookings Institution summary pointed out that stock market gains and asset price increases contributed disproportionately to the net wealth of high-income households. In contrast, families reliant on wages saw slower overall net worth growth because wages couldn't keep pace with asset appreciation. This pattern concentrates wealth while leaving wage growth behind. For much of the 20th century, the U.S. labor market had abundant middle-skill, middle-wage jobs in manufacturing, clerical work, administrative support. But in recent decades, automation displaced many repetitive tasks. Outsourcing shifted many production jobs overseas. Software replaced routine white-collar tasks. According to workforce studies cited in 2025 academic reviews, job growth in the U.S. increasingly splits into high-skill, high-wage roles, low-skill, low-wage service roles, a shrinking middle segment. This hollowing out of middle-wage jobs means fewer career paths offer stable middle-class incomes. Even if workers increase their education or skills, the types of jobs available changed, reducing traditional pathways into a stable middle class. Debt is another big factor influencing middle-class stability. In 2025, U.S. household debt reached historically high levels, with mortgage, student loan, and credit card balances rising. The Federal Reserve's quarterly debt report 2025 showed total household debt continued to climb. Credit card balances remained near record levels. Student loans were a significant factor for younger households. This means many middle-income families use borrowing to cover basic expenses when income doesn't stretch to cover cost increases. Paying interest reduces disposable income and reduces the ability to save or invest key elements of long-term financial stability. Even when broad inflation figures, CPI, appear moderate, individual categories tell a different story. For example, food and grocery prices have stayed significantly above pre-pandemic levels. Childcare costs continue to climb faster than inflation. Insurance premiums, especially health and auto, have risen sharply in many states. A 2025 consumer survey found that middle-income households consistently reported cutting discretionary spending, delaying big purchases, reducing savings. Because housing, food, insurance, and childcare are non-negotiable, any increase directly hits disposable income. This is sometimes called cost of living pressure. One often overlooked part of the middle-class story is geography. A $90,000 income might feel comfortable in a low-cost area of the Midwest. It feels very different in San Francisco, New York City, Boston, Los Angeles. Recent 2025 cost of living indexes show some regions require much higher income to maintain the same standard of living. In parts of California and the Northeast, the effective income needed to feel middle class can exceed $125,000, $150,000 due to housing and taxes. This creates a patchwork of middle-class experiences across the country. If middle-class numbers are shrinking, does that mean the middle class stops existing? Not exactly. Rather than disappear completely, the center of the income distribution is less dominant than before. Middle shares of total income are smaller. Fewer households fall squarely in middle bands. Wealth and gains concentrate at the top. This changes the center of gravity of the economy. Sociologists and economists describe this as a redistribution of income and wealth, not an eradication of the middle class. Let's summarize what we've covered so far. 1. Income doesn't rise as fast as costs for housing, food, insurance, and childcare. 2. Asset ownership amplifies wealth disparities. 3. Stable middle-wage jobs are fewer in modern labor markets. 4. Debt burdens reduce financial flexibility. 5. Living costs vary dramatically by region. All these factors intersect in 2025's economic environment. This creates a situation where even families earning within the traditional middle-income range may not experience middle-class stability. And that's the crux of the middle-class disappearing phenomenon.